Welcome aboard.
Thank you.
All right, if we're ready, I will call to order our General Employees Pension Board meeting. Today, we will have the swearing of the new board member, Dennis Small. An election was held, and the winner was Dennis, and he is serving the remaining 2.5 terms on the seat vacated by Bobby Stacy. Do you do that? Go.
Okay, Patricia?
No, not roll call. Do you do a swearing in?
No.
Okay. Present.
Okay. Bill Collins?
Here.
All right. Dennis Small?
Here.
Kurt Arnold?
Here.
All right. Commissioner Williams is not
Before we go on to public comment, I want to just take a moment to note that there are snacks in the back, compliments of Burgess Chambers and Sterling Capital and the city, to take a moment to recognize our citizen representative on the board, Mr. Arnold, and he has served 16 years of service on the General Employees Pension Board. We very much appreciate his knowledge and guidance over the years and his contributions to a successful pension board. Mr. Arnold has decided to retire from the pension board, and we wish him great happiness and enjoyment as you actually retire.
Right.
And you will be very much missed,
You're here.
Mr. Arnold. And I apologize that we couldn't do Lori Kalachi's home cooking for you, but next best thing.
Yeah, it's very good.
16 years.
Very nice.
Went by pretty quick, didn't it?
So any words of advice for our new board member?
No, just pay attention, ask questions.
Okay.
That's about it. It's more listening than
Yeah.
if you have a background, like I had my security, 15 when I was, so that helps, because you learn a lot about stocks and bonds.
Nothing helps when the actuary presents, though, does it?
Oh, God.
When the actuary talks, you sort of just nod your head.
When the actuary talks, you look at Mr. Lozen and just think, oh, my God, I'm glad there's people like you because I could never do that job.
Yeah.
2 and 2 equals 5, and minus 6 minus 12 times 4, right? Yeah.
Pretty much, isn't it?
Yeah, and you've got one of the better communicating actuaries. Doug does a good job.
Doug is
He
pretty
does.
good.
He does, and
You actually can understand.
yeah, most of the time he kind of gets it down
I
to.
mean, for somebody who's trying to explain how you calculate the next 100 years of pension,
Yeah.
it's pretty good.
Yep. Yep.
Any public comment? Since we have no public, I'm guessing not. Consent agenda, approval of the minutes, the quarterly meeting minutes from August 17th, 2023. Approval of expenses. Burgess Chambers with 2 invoices, Foster & Foster, 1 invoice, Sterling Capital, 2 invoices, Truist, 2 invoices. Retirees, Liz Bass, Holly Gregory, Chris Berry, Steve Dibben. If I can have a motion to approve the consent agenda.
I'll make a motion to approve the consent agenda.
Second.
I'll second.
Thank you. Old business, none. New business, Sterling Capital Quarterly Report. Mr. Mighton, you're on.
Good afternoon. Dennis, welcome aboard.
Thank you.
Again, my name is Blake Mighton, and I work for Sterling Capital, which is the wholly owned investment management subsidiary of Truist. I was joking with Mr. Arnold. He said he was here 16 years. I've been with the bank, shoot, it's 25 years last year. Can you believe that? But I've literally probably had 5 different company names, 7 different titles, but I've done the exact same thing for the last 25 years, which is come out and talk to clients such as yourself about how we're doing with respect to managing your pension. The Cocoa Beach plan is a little bit unusual in that we manage about 60% of the assets, Larry, something like that, 65?
A ballpark.
And the rest is actually managed by Larry and the board through custody relationships and outside, sort of non-Truist or non-Sterling assets. So essentially what we manage is the U.S. equity piece and the fixed income piece of the total portfolio. And then the other 40% is kind of augmented with other asset classes to kind of give us diversification and try to help us beat those actuarial numbers every year. So that's kind of the real quick overview and where we fit in. So I'll talk about our piece of the portfolio in a little bit of detail, but so if we dive into my material behind tab 2, you'll see the third quarter market review, which I affectionately call the scorecard because it's got all of the major stock and bond index returns for the various time periods. The equities are there at the top, starting with the Russell 3000, which again is kind of the broader U.S. benchmark, similar to the S&P 500, sort of encapsulates the largest companies in the U.S. And you can see it was a pretty difficult quarter. We were off about 3 1/4. A lot of that was concentrated in the month of September again. I don't know why, but Dennis, you're going to find out that for some reason, September and October every year are 2 of the worst months for stocks. There's no really rhyme or reason for it, other than, again, just kind of the way it seems to work out sometimes. And it kind of hurts us a little bit more because all of these municipal plans have a 9/30 fiscal year end. So that's the number that the actuary has to use to calculate all his magic and what the city ends up having to contribute, et cetera. So that hurt us a little. But the good news, that's a bad quarter, bad finish, but the good news is if we just go over one more column and look at that year-to-date, or the two more columns at 1 year, that's our fiscal year-to-date number through September. So the equities were up over 20%. So it was a really good period for stocks. And as you'll see in my and Larry's reports here in a minute, it was a good year for the plan as well. So we kind of limped to the finish line, but definitely got there and definitely had a really good year. A couple of things that we've been monitoring all year and what makes this market environment a little bit different than some of the others is how much better growth has done than value so far this year. And the best way to illustrate that is if we look at the third and fourth rows, you'll see the Russell top 200 growth and top 200 value. Those are just the 200 largest growth-oriented names in the U.S. market and the 200 largest value-oriented names. The growth names are recognizable. They're going to be the ones Microsoft, Google, Meta, IBM, those kind of names. Value probably a little less but a lot of the energy stocks, a lot of the financials, whether it be Bank of America, a lot of healthcare names tend to fall in there as well. So what we've seen so far this year is it's really been concentrated in growth. And not only those 200 names, it's really about 7 names that have driven that whole return so far this year. They call it the Magnificent Seven, and they're all associated with artificial intelligence or the speculation on, they're going to be the big winners when artificial intelligence finally, trickles down through the economy over the next several years. What we saw was a little bit of a reversal this last quarter, which is good. We don't want it so concentrated in just one little sector, one little handful of names. And this rally that we've seen so far in November is pretty similar to where it hasn't just been concentrated in a handful of names. It's been pretty broad. We've seen some of those value-oriented companies do a little bit better. But to give you a context, if we look at the quarter, large cap value was a little bit better. The Russell top 200 value was only off 2.4, while growth was off 2.8. But if you look at the year-to-date, growth was up over 28.5, and value barely up to not even 3%. So again, it really kind of mattered where you've been so far this year and over the last year. Thankfully, our large cap growth manager has done very well. But what you'll see for the quarter is he was a little bit under his benchmark, which again, given how well he's done over the last year or so, I think you'll probably be inclined to not be too upset with the return. I'm going to show you here in a minute. But so again, that's kind of one of the things that we follow all the time. We've got exposure to both in your portfolio. Right now, we're pretty equally weighted to both. From time to time, we'll make based on valuations or our best thinking, we'll make a tactical or a strategic call to say, hey, let's be overweight growth or underweight large cap value, overweight small cap growth, those kind of decisions. Right now, we are really about as vanilla as you can be. We're right on top of the benchmarks, both on the equity side and the fixed income side. because really we don't have a lot of clarity on exactly what's going to happen moving forward. We're still data dependent on what the Fed is going to do with respect to interest rates. That's been the other underlying variable that's really been driving markets for the better part of the last couple of years. Last year, it was really bad for the portfolio when the Fed raised rates so aggressively. That was bad, specifically bad for the bond portfolio. We're starting to get a little more constructive there, but right now we think everything's pretty much in fairly valued. We don't see any real opportunities, so consequently what you'll see is our fixed income portfolio is going to be real close to the benchmark. Characteristics are going to be very similar. We'll have weightings in corporates and treasuries and mortgages that are going to be pretty similar. And that's not always the case, again, but right now, that's our kind of, our tactical strategy is really not to have one, which is kind of unusual, but they say if you choose not to decide, you still made a choice, or I forget how that Rush song went, but it's pretty accurate on where we are right now. Is we're playing it pretty vanilla compared to the benchmarks. So, speaking of fixed income, just to give you an idea of it was kind of a rough period for fixed income to finish our fiscal year as well. Down at the bottom, under that blue line, you'll see the Bloomberg U.S. aggregate, and that's kind of the benchmark that we utilize for the portfolio. It was off about 3.25% too. So stocks and bonds were both off about 3.25% for the U.S. Indices this year, and we eked out a very slight positive return if we go all the way over to that one-year number for bonds. So this quarter really wiped out what was really a pretty decent period for fixed income, a pretty nice snapback from last year, but at least, again, we're not looking at negative returns like we saw last year, so that should certainly benefit the portfolio. So again, as we sort of close out this year and look into our crystal ball for next year, like I said, we don't see any real definitive signs that say, hey, be overweight this or be underweight that. We're really going to kind of go with the flow. We're going to be deciphering all the incoming data that we see over the next couple of quarters. We're going to continue to monitor the environment and the Fed and what they're going to do. If you look at what the market's telling us right now, is the market's saying the Fed's done for a while, and that they probably, the next move will be a interest rate cut, but that's not going to happen until the middle of next year. We're probably in that camp that the Fed's probably going to keep it lower for longer, unless we get something else or some other event or stimulus that comes in that really makes him come off of that perch. He's been pretty adamant that he wants to make sure that inflation is dead and gone before he starts cutting rates, and we're going to take him at his word, at least for now. So, wish I had a rosier picture, candidly. It's been kind of choppy here over the last couple of quarters, but certainly a pretty good fiscal year, I think, is the big takeaway. And then obviously, going forward, we'll continue to monitor the situation and try to outperform given the environment as it changes. So the rest of this section goes into a lot more detail on the bigger picture, on growth versus value and how we're positioned, et cetera. I usually don't go into a whole lot more detail there unless anybody has any specific questions. This is the part I usually shut up and see if there's any questions before I switch over to talk about your piece of the plan in a little bit more detail. So I'm going to open it up, see if anybody's got any questions or thoughts. Nope.
Dude, Blake, I got one.
Okay.
Kind of catching you off guard here, should have given you a heads up, but
No worries.
Loomis Sales Fund.
Say again?
The Loomis Sales Growth Fund.
Yes.
Do you know how much it's weighted in those seven, the top, let's say, like the top 10? Is it all tech?
I was going to say, no, it's not. It was very broad, but the couple of bets that they have had, they did have NVIDIA. They had near a market weight, and we're kind of keeping it as a market weight first half of the year. They've since trimmed that a little. And I believe they also had Meta and Amazon in the portfolio. So they didn't have all of them. They didn't have Apple. Microsoft was in the value portfolio for a little while until it got too large. Essentially, just kind of it wasn't a value stock anymore after it popped.
Where it falls.
Yeah, after it did really well, we found other opportunities. So those are the three off the top of my head, Larry. But I'll do a little bit more digging and make sure that.
No, it's okay.
accurate.
I just was curious because they have done so well.
Yeah.
And as you know, in that space, there's just not very many managers who've done well at all, relative to the benchmark. They're all up big, but
Yeah,
that one's done really well.
and the reason for it, and we joked, and we've joked in previous meetings, Larry and I, it's not really the S&P 500, it's the S&P 493 versus the 7. And those 7 are up like 250%, and the 493 are flat. But the market's up 12.5%, 13% so far. The total index is up 12, 13%. It's crazy. So a lot of active managers have really struggled in that environment, and it kind of stands to reason if you think about it, right? Because active managers are looking for value. Even the growth guys, they're looking for what they think is going to do better going forward, and trying to find it at a good price, right? If something's up 200% over the last year, I'm probably not going to jump in right now and hope it goes up another 200, right? Statistically speaking, it's probably going to come down a little bit more before it goes up another 200. But what we've seen is those names have just continued to do extremely well, those 7 names. So, and the other part is now that most of the indexes that we grade all of these managers by, they're market weighted, which basically means the bigger companies have a bigger impact on how that index does, right? So size matters, as the John Morgan ads tell us all the time. The bigger names, and these are, they've appreciated so much over the last couple of years, and they're like humongous portions of the overall index. Those 7 names are up to what, 35? Something
They're
like
about 30% of the S&P. I was going to cover some of that.
Yeah, I'm
It's,
stealing your thunder. I don't
It's
mean to.
tremendously concentrated. We've never seen it like this bad.
Yeah, it's not even
good, depending on if
like
you own them or not.
1999 bad. It's getting to the point where it's a little
Crazy.
bit worse than that. So again, when those names roll over, we're not going to have a lot of exposure, but we are certainly going to have some as we've ridden them up. And
Well, what we've seen a lot of is like managers with really good long-term track records. They'll own the Microsoft and they'll own the Apple, but they don't own it anywhere near their benchmark. Like Apple and Microsoft make up, I think it's almost 25% of the growth, large cap growth benchmarks. Well, 2 stocks. So they like the stock. They might own 6, 7, 8%. They're right on the stock. The stock shot up, but because they underweighted it relative to the benchmark, it hurt them. They don't look as good. So you're sitting there going, well, most active managers aren't going to put 12.5% in any one name.
And if they are, that's not the active manager you want for a pension plan.
Yeah.
I can tell you that right now.
Yeah, so.
Maybe in your personal account, go ahead and play with that, but we're
Yeah.
playing with other people's
Yeah,
money here.
yeah,
And,
yeah.
the active managers that we have on our platform will not take that kind of risk. We simply wouldn't include them.
The Loomis
It
has
wouldn't be on
been
the
a
platform.
home run. You guys changed that one out about, what, 2 years ago?
Yeah,
3?
yeah. And that used to.
That was a home run.
Mr. Arnold probably remembers, large cap growth used to be the laggard in the portfolio there for a while back in the old SDI days.
Early 2000s. Yep.
Yeah, and then we made a couple of changes through the years, and now it's one of the better performers, as I'll show you here in a minute.
We were talking earlier, before the meeting started, about the union negotiations and the impact of really the successful negotiations and how that might impact the economy as the wages go up. Do you see that playing out in your investments?
In certain areas, yeah, obviously it's going to have a big impact on the autos. We don't have a lot of exposure to the autos in the portfolios, so I don't think it will have a meaningful impact
On our investments.
But on the bigger scale, and it's sort of emblematic of a wider scenario where we have seen wages over the last 5 years increase. And as we've said at previous meetings, there's only really one way to lower your wages, and that's fire people, right? And once you give them a raise, they're not going to work for less, right? You can't take it back. So it does tend to stick. It does tend to be a very strong indicator of future inflation when you see wage inflation. Even with certain layoffs and stuff, you can only control it so much. So that combined with some of the initiatives we've seen out of Washington, the $15 an hour, and now it's $20 for California, and some minimum wage initiatives around the country. We are going to see wage inflation is going to stick. It's going to be more sporadic, though, I think, moving forward, because we are starting to see some economic data. Not definitive by any stretch, but we are starting to see inflation kind of come under control at least a little bit. That's what the market was rallying over here the last couple of weeks, right or wrong, and that's certainly a debate that anybody could have because energy prices are still pretty high. Sorry about that. Again, they kind of rolled over a little bit on this last reading and look artificially good, but they're not going to stay down. I was coming over from Orlando today. I saw 283 or 284.
Oh, I know. Crazy, isn't it?
It's awesome. I'm going to fill up on the way home, I promise you. But again, I don't think 284 is here to stay. right? It's really more of a function of some of the geopolitical stuff that's going on right
Do you
now.
think that's going to impact the Magnificent Seven? Are they going to be cutting staff because of wage increases, reducing supply? Is that going to bring those stocks down?
It could. I think from a valuation perspective, I think, rational minds are going to take over at some point and say, look, AI is here and it's going to have an impact, but is it really going to have that big an impact on the bottom line? Because at the end of the day, yes, NVIDIA is going to be a chip maker and they're the leader right now in AI, but I remember Beta was one of the very first frickin' VCR frickin' formats that was going really well. So there's a lot of unknown out there, and right now it's really kind of gotten frothy and speculative.
You know what's weird is the AI, the 7 stocks have all gotten this benefit from it because they're tech companies and a lot of chip makers in that group. But what seems to be forgotten, or at least it's delayed, is rewarding those companies of the 493 that can benefit from
Right,
AI.
that would
A lot of manufacturing companies, a
7.
lot of that are going to benefit from AI,
So
but
do
they
you
didn't
think
get
some of
credit
those
for it.
493, we're going to see those stocks going up as the
My
seven
guess would be there'll be a
stabilize?
rotation because of, like he says, valuations, people just say, these are too expensive. These are not. I think I'll roll my money over here. I think we'll see some of that. And then, again, I think some of these companies in that 493, let's say more industrial companies or cyclical companies, are going to be the beneficiaries of those chips that NVIDIA makes because they're going to implement AI into their manufacturing process or something. And their margins are going to improve.
Should
So
improve,
I think the
exactly.
forecast, if you try to look out
So-
2 to 5 years,
Just have a little
Yeah.
kind of shift smoothing
Kind of where the
out.
focus is, right?
it wouldn't surprise me. That would be the norm, but we haven't seen a lot of norm the last couple of years, so who knows?
Very true.
Who knows?
All right, so if we skip over to tab 3, starting on page 17, and this is the Sterling report. Again, this is about 18 million of the total plan, so again, about 60%, maybe 2/3-ish of the total, but got the pie chart there that shows the target allocation, a little bit more than 50/50, 52.5 versus 46, again, right on top of our target spelled out in the investment policy. But then down the activity summary at the bottom, we've got the various time periods for the cash flows. For the quarter, just to give you an idea, we started the quarter at about 19.2, had net distributions of about 400,000, and again, that's pension payments primarily, because again, you guys are a pretty mature, older pension plan, so a lot of that is kind of factored in. It's about 150 a month, as you see in that monthly column. That 146 is pretty close to what comes out for pensioners every quarter, every month. So about 400 or so for the quarter. We had income of about 93,000, excuse me, and fees of about 35,000, and capital depreciation of just under 700,000. So the portfolio was down about $1.1 million, and it stood at about 18.16 or so at the end of the quarter. Again, to give you an idea, over on the next page, put those dollars into percentage terms. The total portfolio, again, was off about 3.3% for the quarter. Our target index, which was just below that there, I'm looking at the graph in the middle of the page there, the trailing portfolio returns. And our target index, again, is about 52% of that Russell 3000 are U.S. stocks, and then the remainder in U.S. equities. It was off about 3.22, so we were slightly below. That number is including all Sterling investment-related costs, so that's a net number. Down on the bottom, we break it into the various components, the equity and fixed income. That number does not include the investment management fee, so that's a gross number, just so you guys are comparing apples to apples. But again, we sort of limped into the finish line, but certainly a good solid fiscal year. If we look at the 1-year period, the plan was up almost 11%, 10.94, and again, slightly ahead of that target benchmark there by about 15, 16 basis points. And then on the far right, you'll see an inception number, and Dennis, just for your edification, SunTrust / Trustco / Truist / Sterling has had the pleasure of working with you guys for several years, and I'll show you a much longer term number. When we switched over from Truist to Sterling, that was back in March of last year, so that's why you see the inception only about 1.5 years or so. We obviously have much longer term numbers that I'll show you here in a minute, but that's why those numbers, unfortunately, we couldn't port them over and combine them in total, but we did combine them for a total number that I'll show you here in a minute. But I guess the other thing that sort of stuck out when I was looking at the fiscal year numbers, the one-year numbers, was one of the things we always try to do is see, how one piece of the portfolio is doing. And both of them actually outperformed their target benchmarks. Both the equity piece was slightly higher than its benchmark, and that was true for bonds as well. So, and we look at the inception numbers, again, the same is true there, where while the numbers aren't what we like to see from an absolute sense, because last year was just so bad because of the Fed raising rates, it is good to see the portfolio hold up a little bit better than the benchmark, and then both pieces of the portfolio hold up a little bit better than their respective benchmarks as well. So over on the next page, we get into some of the, I call the geeky financial statistics over on the top. Won't spend a lot of time here because, again, a year and a half really isn't enough data to make any determinations. But a couple of things we always look for is how much risk are we taking to get these returns and to slightly outperform. And two of the measures that we pay a lot of attention to are standard deviation, that second column there. And you can see we're at about 13.44 versus the benchmark at just under 14. So taking a little less than the benchmark. And then beta is another measure of volatility that kind of predicts on, if the market goes up 1%, we're expected to go up 0.96, but if the market goes down 1%, we're only going to go down 0.96. So we like to see that number a little less than the benchmark there as well. So again, it's not good or bad, just a little bit more conservative, a little less risk, a little more return. That's certainly what we're striving for. Next couple of pages go into a lot more detail on the asset allocation. We have, again, the pie chart on the next slide on page 20 really does two things. One, shows you that diversification. Each one of those slivers is a different investment strategy, whether it be large growth, large value, small growth, small value, et cetera, and then fixed income as well. And then versus our target down there, you can see we're about 0.5% over, and that's not a conscious decision to be overweight. That's just kind of, we rebalanced back and stocks did a little bit better. So you see we're really right on top of that 52-48 target with our total allocation. The next 2 or 3 pages go into detailed performance for each and every one of those slivers, if you will, each and every one of the strategies. I won't go through all of these, but I will highlight a couple that I think were pretty influential on both why we slightly underperformed by that very fractional piece this quarter and why we probably outperformed a little bit for the year. We talked about it earlier, but that third one, large growth. If we look for the quarter, Loomis Sales is the manager that we have in that category. They were off about 3.48, when again the Russell Top 200 was only off about 2.8, so we slightly underperformed for the quarter. But then if we go over to the year-to-date and that 1 year period and the fiscal year period, up over 33% when the index was up 28, 29. That's the exact reason why we've outperformed. So again, that was the one that really had the biggest impact. As always, in a diversified portfolio, we're going to have some winners and losers every quarter, every year, but we're very comfortable with all of the funds that we're currently utilizing. And again, I think the proof is in the pudding and the performance that we talked about. They performed pretty much in line as we had expected. So with that, I'm going to finish up performance. The next couple of pages take it from an asset class all the way down to the individual fund names. So in large cap value, if we go over to page 22, you'll see the Sterling Equity Income Fund is utilized in that category. And then that third one down is that Loomis Sales large cap growth that we talked about. So really the only primary difference between this report, these couple of pages and the previous pages are we've got the fund names that we utilize in the categories. Really doesn't come in. It's not going to change very much unless we do fund changes in a particular asset class. So let's say we fall out of favor with the small cap value manager we're utilizing, we make a change. You can see how the whole category did under small cap value, but we're only going to show you the manager performance on these 2 slides. So again, not a lot of changes there between those 2 pages. And then lastly, I alluded to this earlier, our historical performance with the city goes back significantly longer than a year and a half that I just showed you. So over on the very first page of the appendix on page 24, what we did was link the historical and SunTrust returns and Truist returns to the new Sterling returns to give you an idea how we've done over the last 3, 5, 7, 10. That inception number is probably not all that relevant because we've had so many changes since 1998, or I guess it's 2001. So again, pretty much in and around it, the 3 years slightly above, 5 years slightly above, 7 and 10 are all pretty solid versus those respective benchmarks. So kind of in conclusion, guys, kind of a crappy absolute quarter. We pretty much performed in line with the benchmarks, but really good fiscal year, and we were slightly ahead. So we certainly call that a win for the portfolio, at least our piece of it. And with that, I'm gonna stop talking and see if anybody else has any other questions, comments. No? All right. Well, as always, guys, we appreciate your business and thank you very much.
Thank you, Blake.
Now Larry will tell you if I'm lying.
Next new business, Burgess Chambers and Associates Quarterly Report, Mr. Larry Cole.
Thank you. Thank you. Good afternoon again. Dennis, our role is really, Blake kind of said we were managing the other 40%. We're actually your investment consultant and your performance monitor. So we oversee the entire portfolio. And we will evaluate, they're one of the managers, right? You've got a lot of managers, they're one of the managers. It is a little different than a lot of plans that I work with in that at one time, SunTrust, it's probably SunBank back then, had all of the assets. And SunBank Capital Management was the subsidiary of SunBank. They had several different investment disciplines under one roof. So there was a large cap growth team, a large cap value team, an international team, a small cap team. You know, they had all those, a fixed income team. So they managed all the assets. As the plan grew, and I guess merely as markets became more volatile, maybe that had some impact, but more as the plan grew, we wanted to add some different asset classes to diversify the portfolio even more. A lot of those asset classes, they didn't have under their roof. So we went outside to get those asset classes. I'm with a firm called Burgess Chambers and Associates. We're independent. We don't have any affiliation with any brokerage house or anything like that, and we don't manage money. We consult, and we help you find managers to manage portions of your portfolio. So we'll develop your overall investment policy for you, review it, change it when necessary. We had to revise it last quarter because of some recent legislation. But we'll do the investment policy, which has the goals and objectives of the fund and all that. And then that'll also include an asset allocation portion, you know, how much do we want in bonds, stocks, real estate, whatever. And then we will recommend managers to fill those slots. Well, for 60% of the portfolio, because of the way SunBank, SunTrust, whatever has evolved, they're now picking funds outside of the Sterling umbrella to meet some of those objectives too. So we're kind of evaluating Sterling by themselves as one of your managers for the equity income fund and the fixed income fund. We're evaluating Blake and his group for that 60% of their portfolio. How are those funds doing that they've selected? You know, are they doing a good job there? The short answer to that is yes, they're doing fine. And then sometimes I'll get with Blake and say, you know, I just noticed, you know, this particular fund's not doing very well. What are you guys thinking? Are you ready to make a change internally? And, you know, we'll have that discussion. Usually we're on the same page, pretty close, and they've already said, you know, they spotted the same thing I did. That fund's not doing well, and they'll go find another one. But we end up then, there's about 40% of the assets, as I said, that don't really have that discipline under their umbrella. So we recommend managers to you for that other 40%. So, and these reports can get pretty complicated in addition to being pretty boring, but if you have anything as you're trying to get up to speed, you want to call me, you can call me direct. I'll leave you my cell number. You just can't have another trustee in the room, you know, because of the sunshine laws. So feel free to do that if you know, just trying to get up to speed, looking at this report, don't understand it or something down the road. Feel free to give me a call. So a lot of what I'm going to say could be, you know, a little bit of a repeat of Blake, but pages 2 and 3 of our charts, of our report, shows the markets in general too, and Blake already pointed out everything was kind of down for the quarter. When we sat here in August of the meeting, everything was really looking good. I think your fiscal year-to-date number was probably up 14% or somewhere in that range when we met, and we were hoping we could hang on to it for the last 6 weeks of your fiscal year. As usual, September blew up, and so we lost about 4%. But you still did have a good quarter. I mean, a good fiscal year. You were up before fees. You were up 11%. You'll see that in my report overall. So 11% year is your actuary is going to like that. That helps. But we need a few more of those to make up for last year. You know, that could be a good way to put that. So that's what 2 and 3 are. They're just kind of market summaries. They're not your plan. We usually provide a summary on page 4. So You can look at that quick and, kind of get an idea how your plan did. We've got the policy review on page 5. I don't usually cover that with you in too much detail. We'll go through the report in a different place. Page 6 is the first look at performance for the different time periods, and you can see for the quarter on page 6, we started off at 30.8 million. The net contributions, you have contributions going in, benefit payments going out. The net was a minus 439. The market value loss was about $1,172,000 this quarter. All of that, I'd say, at least 90% of that in September. And then your ending market value dropped down below 30. The good news about that is every time we go over 30, we bring cupcakes and cookies. So we've been oscillating above. So yeah, as we sit here today, we're over 30. So if it holds like it is now, we'll bring some more. Not quite the spread we have back there today, but we'll do good. But your fiscal year, as you can see, net of fees, 10.6%. That was a little bit ahead of what's a strategic model is really your benchmark. It's spelled out in your investment policy. That's what we want to try to match or beat. Your asset allocation on page 7, this is the total portfolio and how it's split up. It's a little misleading that we have a large allocation to what we call core, and then this is all under Blake's umbrella. A large allocation to what he considers core, but then they supplement that with a growth manager and a value manager surrounding that. So overall, the best way to look at this is to add them all up and see how they weight relative to the benchmarks. So you can see all the different asset classes that you're invested in. You're extremely well diversified. We do have, if you found fixed income and cash right now, cash is sitting in money market funds that just 18 months ago were paying 0, and now they're paying 5% plus. So I'm comfortable leaving it there. They use that cash also to pay benefits and expenses and whatever too. So we don't have to invest it necessarily to make money right now. So getting paid 5% on that. And that's just, if you add them up, that's just slightly over the benchmark or the target allocation. So that's good. We like bonds right now. I think I'll kind of repeat my spiel from the 457. I also work with the 457, help out on the 457 plan for the city. But the Fed has a target of 2% for inflation. The numbers came out this week. Everybody got super excited over 3.1% inflation number for the CPI. But if you take food and energy out, which is called the core CPI, it was still at 4%. And the only reason the CPI dropped down to 3.1 this last year really is this last month, energy prices dropped pretty significantly. I can't explain that. We had a war in the Mideast. When a war breaks out in the Mideast, usually it goes the other way, but instead it dropped 20 bucks a barrel or whatever. So I don't think that'll hold very long. So I call it a head fake. I think that reaction this week to the market, I love it, but I think it was way overblown. Because they think the Federal Reserve is done raising rates now and rates are going to peak and start rolling back over. They're nowhere near their inflation target. Core CPI is still 4%, and energy is probably not going to stay down at these levels very long. And then Patricia mentioned all these labor contracts and these strikes and what they're getting out of them. It's very significant wage increases. Great for the worker, bad for inflation. That's inflationary. People are going to spend that money, and it's inflationary. That's just economics 101. So you got a lot of pressure still on inflation that the market just seemed to totally disregard this week. So I'm in the camp that the Fed will probably raise rates at least one more time early next year, and maybe twice, depending on, it's all data dependent. But I don't think they're done because they're nowhere near their target. And Powell has made it clear this is his target. So the only way they get to that target without, without additional rate hikes, I guess, would be if we did start seeing a ton of layoffs and the economy just tanked. And nobody's really predicting that. This is the most forecasted recession I've ever been through in my career, and it isn't here. Or we already had it and didn't know it. So I just don't think that's going to happen. But in reality, the Fed's got a really weird job. Their job right now is they want the economy tanked. But they can't say that. But that's what they want. They want to crush the economy, slow down growth, so they can get rates and inflation back under control. So if unemployment shot up to 6%, behind the scenes, they'd probably be thrilled. But it's not doing that. Not yet, anyway. So, and at the same time, the Fed's trying to do that, government's spending like a drunken sailor, right? So that's totally, opposite of what the Fed would like to see. So it's really a tough battle. I wouldn't want to be Chairman Powell right now. He takes a lot of heat. But all that to say that I don't think the rate hikes are done. I hope the market holds in there. We're having a great quarter right now. Things are really looking good. I think it was correcting a little bit today, down about 100 when I came in, I think. Off a little bit, the Dow, but nothing too serious. We talked about the Mag 7, and I just got a couple other boring statistics to share with you, but those 7 stocks, he talked about how concentrated it was. That's the most concentrated we've ever seen in history. They make up, actually, I think it's a little over 30% now of the S&P 500. They've been responsible, those 7 stocks have been responsible for about 80% of the U.S. stock market's returns year to date through September. 80% out of 7, just 7 stocks. If you actually took that S&P 500 and instead of market weighted it, did a equal weighting of the 500 stocks, the equal weighted S&P 500 is actually negative year to date. So that shows the influence of those stocks. Those stocks are up on average, those 7 are up on average 92% through September, I think it was, average, 92%. So you either own those and you were happy, or you didn't and you didn't. You didn't beat the market. At the same time, over the last 18 months, rates, as I've mentioned before, went from 0 to 5%, record rise in rates, killed the bond market last year. We didn't have any protection from bonds. And because when rates go up, I don't know how much finance stuff you've got in your background, Dennis, but if you hold a bond already and rates go up, the market value of your bond goes down. If you're an individual and you have a 5% bond that's due in 3 years, you don't care what the market value does. You just know you're going to get your 5% and then you'll get your money back at the end of 3 years. But in a pension fund, we have to value that bond at the market value. So as rates go up, your 3% coupon's not worth as much anymore, so people won't pay as much for it. So anyway, that's how last year bonds were down 14%. So, and stocks were down, I forget how much, a lot. So really a weird environment ever since they shut the world down from COVID and fired it back up. So volatility's just been extreme. But in the market itself, small and mid-cap stocks are pretty cheap. Blake's got a pretty good allocation to those in their portfolio. I like that. They're very cheap. I think this growth value story, there's kind of 2 major styles of investment, growth versus value. Growth is, I think you quoted numbers about 26% outperforming value. Last time I saw that was the late 90s during the dot-com era. And when it rolled over pretty dramatically to the value side. So basically we're talking about the S&P 7 versus this 493. And when you look at the valuations of the two, these 493 look really cheap relative to those other 7. So I think I don't think the market's going to crash necessarily, but I think there'll be a rotation of a lot of money out of those expensive stocks into what look like better values on the other side. So hopefully we'll see that. In other words, it's another term for just broadening out of the market returns. So I think we'll probably see that. This is just a quick chart. These are the 7 stocks. It's NVIDIA, Meta, Tesla, Amazon, Apple, Google, and Microsoft. And then there's the rest of the S&P. So you own them, you're happy. NVIDIA is up over 200% year to date. So if you were a manager and just in January said, that stock looks a little expensive, which it was to some people back even on January 1. So you said, I don't think I want to own it. That probably cost you several percentage points relative to your benchmark or your target just from that one decision. This is where I really nerd you out. This is the PE ratio for the S&P 7 versus has gone from 29 to 45. That's the price to earnings ratio. So the price to earnings ratio has gone from 29 to 45. This is the 493. The S&P 493. Same thing here. The combined weighted return of those S&P 7 is over 50% and the rest of the market flat. So it's just not, I don't think it just can't continue. So stay patient with any active managers that are underperforming. Blake and his team have done a good job with the portfolio they've got. The group we have, if you go to page 12, just looking at the returns for the total fund, so this is everything, including their portfolio, down about 3.8 for the quarter. The one-year number was 11%, so your fiscal year was 11. Your 3, 4, and 5-year numbers, those are annualized numbers. And Dennis, just for your knowledge, about 18 months ago, every one of those numbers was double-digit. So that was the impact of 2022, just pulled everything down there in their 3, 4, and 5-year numbers. As far as, I'm not recommending any rebalancing right now. You're about 31% in fixed. I like that. Commercial real estate has hurt us, but I do believe we're getting close to a bottom there, believe it or not. If rates start to roll over, that will help. And we might be a year away really from that happening. But I talked to portfolio manager. JP Morgan has probably the largest fund, I think, in the country. And I was on the phone with their portfolio managers just about a week and a half ago for over an hour with them. And just as an observation, they're in Midtown. JP Morgan, is Jamie Dimon's the chairman there. He's been really encouraging his people to get back to work. I talked to the managers and said, what are you seeing in office space, this legacy office space in these big cities? And in New York, they said their occupancy rate is still about 90%. And she clarified that the 90% doesn't mean 90% of the people are at work. It's the leasing. They're leased out 90% and getting paid on 90%. But she did say that Midtown Manhattan has picked up a lot. There's a lot more people there that you're seeing the impact of the Jamie Dimon saying get back to work. A lot of people are telling their people to get back to work or get back to the office, I should say, not necessarily back to work, but back to the office. I don't know if you caught that last time, but I think I might have mentioned it last quarter, but Zoom told their people to come back to the office. I just find that so ironic.
That's funny.
Zoom, get back to work. There's a trend there, so that's why I think.
They found video conferencing not effective?
Yeah, I guess so. So I say all that just because I think we're closer to a bottom there, and I think the valuations may be reflecting that for the most part. So I'm hoping to see a little turn there in real estate. You don't have very much. I think it's only about 4.5% of your portfolio, but I do expect to see some improvement there. The last page I'll cover with you is on page 16. And Dennis, for your benefit, these are your fiscal year returns going back to 2005. And when I say things have gotten wild the last couple of years, you can see it. 2021, we had a fiscal year return of 21.68%. The next year, we were down 18%, and now we're back up 11%. And I know I said this to you last quarter, but if you'd have told me you could have this a diversified portfolio with best-in-class managers in each of your asset classes and see that kind of volatility in a 3-year period, I'd tell you the odds of that were almost zero, and I would have been dead wrong. So we've never seen it before. And that's just extreme volatility. I think things will start to settle down. I'm hoping they have, maybe. When the Fed gets through with this cycle, if they're done raising rates, that's great news. If we can get inflation back in that 2 to 3% level consistently, then I think, the economy is really set to take off well. So, no changes to your allocation. It's a long-term proposition with a pension fund, so don't get too alarmed at all these short-term volatility. Mr. Arnold has seen a lot of it over the last 16 years. I've actually been here most of those, I guess. Yeah, because I joined Burgess in 01. I'm coming up on my 16th year with Burgess, so yeah, whatever that was. 05 or 06, something like that.
You
07.
guys got to get cracking, because in the next 2 years, you got to get another year like 21, or Doug's going to kill me when that 21 drops off of that averaging. He is going to, we're going to have to put so much money in.
It really.
So got to smooth that average.
Yeah, well, I've heard a lot of actuarial presentations, and it's almost like 2021 didn't exist. Yeah, you're up 22% one year, down 18. I said to the actuary, isn't that good?
Well, yeah, because they kind of counterbalance each other, but when 21 drops off and you've only got that negative in 22, Doug is going to come back and go,
we need some,
that percentage went from single digits right on. And then it's going to run off the next 22.
Well, you know Well, the actuary actually did point something out to me too that was not good news, but he pointed something out. You know, you have, let's say, I can't remember, are we 7.25 here for the?
I think we're at 7.25 right
Assumption
now.
rate, 7.25, I think, too. All right, I'm gonna say 7 because it's easier to do the math. Let's say your assumption rate is 7 and you made 21. Well, he's already assuming you're gonna make 7, so you really only got a 14% bump there, right? Now flip it over. I assumed you were gonna make 7 and you were down 18. That's a minus 25% hit from the actuary's viewpoint. I said, that kind of explains why 21 didn't offset 22 necessarily. So,
That's true.
Now take that out of your averaging, your rolling average,
yeah,
and you don't have that big positive.
yeah. We had so many good years too, you know, it was a nice run up until
Well, Doug doesn't
22.
look at the previous good. He's only gonna pick up
I
that
know.
bad one,
I know.
and he's gonna kill us.
What are you gonna do for me
Unless,
tomorrow?
unless you
What'd you do for me
guys,
today, not yesterday? right?
unless you guys give me another 21 in the next year or two, counterbalance that.
Can you take 2 11s instead of 121?
No.
No, uh-oh. Uh-oh.
The math, yeah, the math doesn't work for me.
You
I
an
need
actuary
another
or
big
something?
one in there.
You an actuary or something?
Do I,
2 11s doesn't replace a 21?
not that I've seen Doug do.
Yeah. Yeah, it's, who knows? Put it that way. Crystal ball's not that clear, that's why we have it diversified and spread out.
Well,
Hopefully,
Doug did say this is gonna be painful when 21 drops off. But you guys could save it.
Hey,
You could
we're-
make it not painful.
if we got 11, 11, and 11, that would help.
No, I need a big one in there to counter, I need a big win. Big win.
Yeah,
So it might be time, the year before 21 rolls off, is when you do a new, actuarial study to see what other variables may be able to, salary increase.
Didn't he do-
modify, all of that other stuff.
Didn't he do that, not, I think last year, the year before?
Usually do it once every about 5 years.
I think it's every 5, something, yeah. I don't think we're up for the full,
I think Blake makes a good point, though. You probably want to bring that up with Doug. If you haven't, just say, you know, when 21 drops off, before that happens, can we, or at the same time, can we maybe run it again, see if there's some other areas where you can offset those costs?
Offset that.
Yeah,
Because again, we do know, at least right now, it's a 1-year event, right?
Yeah.
correct.
That's a good number next year. Once that drops off,
That was painful.
It should go up. Everything else being equal, obviously, but might find some other relief that 1 year.
But Mr. Arnold, it has been a pleasure. You've been a great trustee and asked some good questions and tried to keep everybody out of trouble.
Yep,
Appreciate it.
thank you.
Not too many people volunteer 16 years on a board.
It's been a long.
That's really
long-
special. So,
Time to change.
yeah, that's really special.
Need some younger blood.
And the results speak for themselves.
Yep.
It's part of the
Long-term results. That's exactly right. Had some good discussions and. Any questions then?
What is since 2005, what's the overall?
Since '05?
Yes.
That's a good question. I don't know off the top of my head. I'd have to just run those numbers and see what the average is.
I mean, most years you were up.
Yeah, yeah, big, actually. A lot of double-digit years in there.
Mark was great from
I don't know, Dennis.
all the way till the crash in 20.
So that's,
This was the big crash.
Yes.
Yeah.
Yeah, I remember that. I looked at my TV portfolio and,
19
I'm
years.
on up and understated.
what, oh, yeah.
The
Yeah.
2008 year.
I would say, I'm comfortable saying we're over the 7.25, which is your assumed rate, but I don't know exactly what it is. I just have to do the numbers. Get back to you on it, maybe. Yeah, I don't have anything to look here. Good question. So if you look at all that, I got something.
So would it be the same thing minus inflation on average, 3%? You're really +5, you're saying?
With inflation?
Yes.
Well, yeah, I guess you'd look at it that way in terms of real rate of return relative to inflation. if we can always get, if you can get +5 to inflation, you're, I think, gonna be pretty happy in the long run. You gotta remember too, the better part of 08 through 2020, inflation is 0.
Correct.
Right, so. That helped.
Historical 2 to 3%, so that certainly kind of helped.
Last couple of years,
Yeah.
not so good.
Not so good. It's usually about 3.
No,
Yeah.
I look at my stuff.
Well, if inflation, they said CPI was at 3.1 for the last year, and that was October numbers, but anyway, 3.1, and you got 11, so we probably did CPI plus 7 or 8 for this year, but there was a couple of years there where we didn't touch CPI, got hit. You lose 18% when CPI was 10. So, yeah, when we had all the supply chain issues, that was a rough period there.
The addendum is separate from the House bill.
That's all I've got.
Okay.
The rest of the book has a lot of information on the managers and longer-term stuff that can put you to sleep in about 2 seconds. But it's a lot of the analytical stuff we use to evaluate managers and stuff.
Like, we talked about this at the last quarterly meeting, the addendum. You just need signatures.
Yes.
The policy too. Do you have the policy itself?
Yeah, we have the policy.
Yep.
Is the policy changing to reflect the changes in House Bill 3?
Yes, it is. Do you have the red line draft?
No, but it's okay. So, to speak briefly, House Bill 3 was passed in the past spring, and it has implemented a few changes, one of which is affecting the pension board. Our attorneys, the pension board attorney, Sugarman Susskind, has given a special report, which is in your packet. And one of the things that we have to do is we have new reporting requirements. So we have already completed by the November 3rd deadline. We did complete this. We followed that link and did that reporting requirement. But we do have to have filed by December 15th. What is it, the reports on this?
A little one-pager and
Yeah.
investment policy.
But it-
New language that sort of addresses the bill or the new statute.
Basically, really long and short, the state is trying to just ensure that the pension plans are being managed in a way that ensures that there's no problems for being able to pay retirees when they retire. So the state is saying that they just want documentation that we have proper assistance in managing our pension funds. To simplify.
Well, yeah, and HB3 specifically was what I call kind of the anti-woke, anti-ESG bill, and that all it was trying to do was make sure that your managers that you hire or have, particularly hire because it's effective July 1, are making investment decisions on a pecuniary basis only, and I had to look that word up, but it means that their decisions are just to
Monetary.
make you money. They want to make money. They're not trying to set a social agenda. You know, that they're going to buy this because they like windmills. You know, they're only going to buy it. They could still buy a company that they like because they do windmills, but only because they think the windmills are going to make them money and make you money. So that was sort of what the intent is of that part of HB3, was to just say, hire people that their only interest is to make the plan money.
Here's the irony. Amongst other things, there's a few with this House bill.
Yeah.
The federal government, for granting purposes, require that we specifically make financial decisions based on social economic,
The federal government.
the federal government. So if we are in compliance for the federal government granting agencies, we are no longer in compliance with House Bill 3.
I did not, that's the first I've heard that.
Think about it. So,
I've heard that Mr. DeSantis, again, politics aside, the state actually put 2 ESG funds into state retirement plans literally months after this legislation came through. And with the understanding that, hey, it's ESG, but it's going to make us money. That was.
Yeah, it doesn't forbid it. It
And so
just
that's why you
says,
really got to say this.
Yeah.
but-
as long as you can say, we are making the decision for this, it might be an ESG, but we don't care about that, we care that it's going to make us money. So you can kind of bypass that part of it, but it's, this House bill is sort of, I mean, I understand the intent of it, but whoever put it together didn't actually connect all the dots.
And it could be repealed.
and that
Next election.
that surprises you?
It's kind of what to do about
Did I say I was surprised?
No.
I'm just not really sure.
It's hard,
Yeah.
we don't know how to report, you know, that your attorneys have kind of taken over on this on the reporting, because nobody knew what to do. And I still
Well,
don't think
I
we
mean,
know. what to do.
here's the thing. So you have grant monies that come, that flow through. Maybe they're indirect. So now you've got Fed going through the state, going to the city, and we want to invest those funds until we spend them. Do we follow state law?
federal?
Do we follow Fed?
Whoever gives you the money. Because that's the other thing, you gotta be in a general plan, don't get a piece of the homeowners and auto insurance like police and fire plans do. So they get state contributions from those sources, so they're gonna probably be more inclined to stick with what Mr. DeSantis says. You guys in the general plan don't get those monies, so I would go with that would.
For our pension, yeah.
If I were in your position.
I would look at my attorney and say, what do I do? That's what I
Well,
would do.
for the pension plan, for our general employees pension plan, yes, we follow state. And yes, we just say, all we care about is money. We don't care if anybody dies in the process, we just want to make money.
Well, quite that extreme, but yeah, I get it.
I mean, that's kind of the harshness of this law.
Seems unenforceable, you know.
That's what I've determined.
So,
Totally
I did it to
unenforceable.
make money.
no,
But what you would have, and we've seen as a consultant, because we get called on by every manager in the world, we do a lot of due diligence visits, but there are some managers who, yeah, and a lot of these management firms are located in big metropolitan areas that are pushing certain agendas, and they will come in with that agenda, whether you agree with it or not. Some of them I do, some of them I don't. But the point is, they're pushing it, and when you get then, you're dealing with public money, and you've got several people sitting on that board, not everybody's going to agree on that agenda. So that's why they're trying, I agree with you, the way that bill has come through is terrible. But I think you have to, you know, when we find managers for you and recommend that you hire them, it's not because, it never has been because of their social practice or what we, you know, that they had 20% of their portfolio in ESG funds. It's because they had a good track record, a solid philosophy, good history, stable management team, that sort of thing, and they could make you some money and help offset the costs. Doesn't always work out, but that's what we look for.
yeah, the bill is an attempt to ensure that we're making financial decisions based on finance.
Yeah, right.
But they didn't think through everything they said. And the conflicts, which is where the attorneys came in to try to render an opinion on those conflicts. And are there punitive measures? It was like April?
Ridiculous.
You have a December deadline to file.
Yep.
It was just.
Yeah, I think this passed in what, April or May, effective July 1, and filing by December. But there are no punitive. If you read the House bill, there's no, if you fail, this is the consequence. There's nothing in there.
That's true.
But stand by.
That's the weirdest thing, I agree.
But-
But it sure has caused a lot of people to jump through hoops, and it's very expensive because you've had to pay attorneys, and it's just, every plan we have, the investment policy had to be revised. It's just created a lot of work.
But the decision before the board is to approve the modifications to our investment policy to be in compliance with House Bill 3.
Excellent summation.
I mean, how do you really, I mean, I don't know. I spent an hour trying to go through this with my city attorney and trying to explain what the
conflicts.
House bill was saying and where my conflicts are. I mean, look,
You're the first one to mention that in my meetings. I haven't heard that. That's an interesting point.
part of what it did to us is we have to get a letter from each of the institutions that we have money invested in, right? We have to have that institution affirm, attest that they are a QPD, Qualified Public Depository. That includes anywhere we have funds invested. Most of our funds are invested with the LGIP. Guess what it isn't? The state is not a qualified public depository. And yet the state just said, I have to have something from each place that I have money. If I have money on deposit, invested, I need a letter attesting that it's a qualified public depository. Only the state is not.
That's bizarre.
Do I pull my terms out because they're no longer in a QPD? Right? Someplace not safe? I mean, see what I mean? They did not connect the dots here. And I understand the intent. They want to make sure that we are putting government funds in a safe institution. But they didn't look at the fact that most government agencies put their investments with the state, which is not a QPD. Now, Sterling Capital is, Burgess Chambers is, you guys are fine, but the state's not.
I remember it a few years ago. I came across I can't remember what the situation was, but I did. And
Qualified
it was
public-
something like what you're saying, that somebody had some money, one of the cities I was working with had some money somewhere, and it might have been with the state. I can't remember if that was it or not, but it wasn't a qualified. And there's a big list. You go online, there's a big list of them.
Technically, the state is not a qualified public depository. They, by their own state law, do not meet the definition of a qualified public depository. So according,
Running that little collective fund, right? For a money market fund for.
I mean, where they invest it probably is, but where we invest it, it is not.
Well, they did something similar to that many years ago when they had a ban on Venezuela or something. There were certain countries you couldn't invest in. It wasn't just Sudan. Yeah, public scrutiny. And at the same time, they were putting Valero stations at every turnpike stop.
It was Shell, yes, it was Shell.
Well, Shell, that's what it was. It was Shell. You
Shell was
couldn't,
on the list.
Shell was on the list.
And names you can't buy.
Yeah.
Because they did business with our.
That's right. That's what it was.
Oh,
That's what it was. It was
But then the
Shell.
contract for all of the stations got renewed.
Was Shell.
Went from Valero to Shell.
To Shell, that's right.
And Shell just got the contract.
Yeah.
It's not all that.
But you couldn't own it in a pension
fund.
fund.
State funds, literally months after they come out with this.
Crazy.
It's
State.
politics.
So does the pension board have any questions, comments, or concerns about the changes to our investment policy? Then if I could please have a motion to approve our modified, updated investment policy.
I assume.
Thank you. And a second?
I'll second.
Thank you. Sign that. We talked about this last week. It's an addendum to our statement of investment policy with Sterling. If anybody has any questions or comments about this.
What did we change on that, Larry? Do you remember?
No, and I didn't bring my copies with me. I had them last quarter, but I didn't bring it this time.
I think literally the only thing that changed on the addendum was reference to the name global policy, which has changed. So you go-
Seems like there was one other thing you asked me to look at. I'm sorry, I should have brought the word.
I meant to call you on that, and I apologize, Larry, I forgot. Just to ask what the changes were. And I'm pretty sure I looked at it, couldn't find it.
There is a reference in that addendum to the broad investment policy. So an addendum to the policy is just for that manager that's doing separately managed like they do, saying, you know, here's your specific goals and objectives, and everything else, you gotta stay in line with what's said in the investment policy statement, dated, blah, blah, blah. So we had a new investment policy statement, we need to do
That's, I
that.
think,
Yeah.
really the
Okay.
only significant change.
Yeah.
And it makes sense, because you've got that new language, and it basically goes into testing, and you understand the new language is very policy. Since I don't think our signature is required in the global policy, but it is.
It isn't on the overall, just all we need to do is you, by signing that, you acknowledge you've seen that policy.
Correct. Does that make sense, Patricia?
Yep,
If our signature's not on the main policy, it's on the.
yep.
We'll make sure you sign it before you leave.
I can't sign that, unfortunately, but if you guys sign it, I will.
Take it
scan
back.
Send it to my compliance person, and get you a copy back ASAP.
Wonderful.
Yep. Any questions, concerns, thoughts? Then if I could have a motion to approve signing this addendum.
I'll make a motion to.
Come on, Dennis, step it up. I need a second.
Second.
Thank you, Mr. Arnold.
Ernie.
So that concludes the new business. Informational items we just discussed, that is about the special, the HB special report. Okay. This is on Florida Retirement System. And this is on the House bill. Any questions, comments, or concerns about the informational items? Moving on, next quarterly meeting is February 15th. Happy Valentine's Day, 2023.
2024.
2024.
Is the 15th the actual date then? Okay,
This
Yes.
is 2020.
then we'll actually have that meeting in the new fiscal year, new calendar year of 2024. Some people want everything perfect. I mean, we could lose a year off the visage, that would be all right. And we're adjourned. Thank you very much. Please take food with you.
Really?
Best of luck.
Thank you.
All your
Yep.
future endeavors.
It's been good.
You'll be missed.
Yes, and if you get bored, come join us.
Yeah.
Public comment.
Public comment.
We'll have public comment.
One person out there, right?
We never,
I might be, just for old times.
If you're really bored on a Thursday.
Right. If I'm really bored. Well, that's been a good one.
Yeah.